So thank you, Piyush, for all your help in making this happen. You know, we want to be global, and now that we're here, we can say we are more global than we were 24 hours ago. So thank you so much for your help and support in putting this together. But we're not global, we're New York.
We're New York.
And we've never met each other till today, even though we're both based in New York City. It's my great pleasure to introduce Adrienne Harris, who's the Superintendent of the Department of Financial Services for the state of New York. Adrienne's had a very interesting career already. She's already had a couple careers. She worked in the White House, she worked at the Department of Treasury, she's done some startup companies, she's taught at the University of Michigan, and now she's the superintendent of DFS. Before I start our conversation, I want to just tell you a little bit about the Department of Financial Services in New York. You might think, well, why would you care about this financial services department for one single state of the United States? Well, it turns out DFS is really, really important because New York City is one of the major financial centers of the globe, and a lot of entities that do business in New York are chartered by DFS. A good chunk of the foreign banks that do business in New York are supervised by the Department of Financial Services. The other advantage that DFS has is that they're one entity. They do insurance, they do banking. It's not like the national regulators in the US where we have the FDIC, the SEC, the Federal Reserve, the CFTC, the Office of the Comptroller of the Currency. Imagine them trying to get their arms around crypto and digital finance. So Adrienne has an advantage here where she can do it in a sort of comprehensive way. And they've really already been leaders. New York State set up what called BIT licenses back in 2015, which set the parameters for how you could actually engage in cryptocurrencies in the state of New York, way ahead of everybody else. So let me just start, and first question, just ask you about how do you see the role of DFS in overseeing regulation of digital finance?
Well, first, thank you for having me, and it's an honor to meet you and sit with you here today. As you said, DFS really is a global regulator. In addition to being very local, it's very global. We regulate 80 foreign banks, 120 state banks. So all in all, between the insurance companies, digital currency companies, we regulate about 3,200 institutions, about $10 trillion in assets of global institutions. And we really are the only prudential regulator in the country, either state or federal, with explicit authority over digital currency. And as you mentioned, we have the BIT license. We also have the limited purpose trust charter. And so it gives companies that want to be regulated by New York the option of choosing a chartering regime that fits their business model. And often what I say is, especially as the federal government looks to figure out how they're going to regulate the space, if you're going to step back and ask, what does good look like in regulating digital assets, you would really come up with the New York framework. And that's not me patting myself on the back, because as you said, it's been in place since 2015, before my time. But we have robust capitalization requirements. We have robust cybersecurity and BSA, AML requirements. We look at financials on a quarterly basis. We do deep background checks on all the executives and investors. For stablecoins, we have one-to-one reserving for on-chain and off-chain assets. We require that the reserves be in cash and cash equivalents. We're very prescriptive about that. We require T+2 redemption. So we really are sort of on the bleeding edge of crypto regulation and have learned a lot in the short time that this industry has been around. And I think the proof is in the pudding when you look at just how well the framework has performed. You see that in New York, we had not approved any algorithmically backed stablecoins for issuance or use in New York. And that, knock on wood, our companies have fared very well through the crypto winter, and we haven't seen bankruptcies from our licensed entities.
So what are your top priorities right now? So
Yeah.
you've done this so far, but there's a whole bunch more to do.
There's a whole bunch more to do. Well, one of the things I've been doing in the department is really staffing it up. And I'll talk about policy priorities as well. But of course, you can't make policy, you can't make regulation unless you have the best talent in the world. So when I got to the department, I sort of backed up and said, what are the governing principles going to be? And I came up with what I call the 3 Ps, which are policy, process, and people. On policy, I'm a firm believer that you can protect consumers, protect institutions, protect markets, and also be good for business. I don't think those things are diametrically opposed, as is often the framing that financial regulators use. On process, we had a lot to do to just make the department work a lot better, and we continue to engage in that work. And you can't do any of that unless you have the best, most talented people. So we've already added 200 people to the department. The department's about 1,200 people. We've added about 200 people this year. Our crypto unit has grown from 3 people when I got there to 45, and we still have more to go. But we are looking to do more in the digital asset space, certainly around consumer protection, disclosures, advertising. You'll hear more from us soon on bankruptcy and orderly liquidation authority for crypto companies. So we really do have a lot that's baked into the regs, but where we're going to be looking to give the industry more guidance.
And how do you think this will work in helping New York City maintain its important role in finance? What does good look like?
Well, I think for us, we see it on the ground every day. If you look at investment, private equity and venture capital investment in crypto in 2021, 46% of it was in New York regulated companies, which is actually 2x Silicon Valley and 8x Miami, despite them holding themselves out as the crypto capital of everything. And I think it shows that the responsible actors, or those that really want to have growth and have institutional partners, are looking for and need a transparent, robust framework because they want the predictability for their business. And their customers want to know that they're regulated, and the institutions they partner with want to know that they are held to a certain set of standards. And so it really has helped make New York the true crypto capital.
How do you find the communication? As a regulator talking to people in the fintech space, I found in my own experience that a lot of time you need a translator in the middle, to explain what you're trying to accomplish.
Yeah, well, as you mentioned, I myself have been a fintech founder. I founded an AI company in Silicon Valley that then went public. And so I have been in the entrepreneur's seat. I also, when I was in the White House, stood up the distributed ledger task force, which was mostly national security based, and this was back in 2015. So I feel fluent in the language, and one of the things that I've worked very hard to do since coming into DFS was to make sure that we were much more engaged with industry and all of our stakeholders. I'm the first non-prosecutor in my role. I'm the first person with any commercial experience in my role. For people who are regulated by New York, you understand why that's important to be the first non-prosecutor, because the agency really has been known for its aggressive enforcement, less so for rulemaking and policy making. And I've really sought to change that. And part of the way we do that is by engaging with all of our stakeholders, including industry. So when we wrote our blockchain analytics guidance recently, when we issued our stablecoin guidance recently, we were talking with industry and asking what they do, what should they do, what can they do, what's operationally possible, what's really going to make them safe and sound. And we do that with all of our stakeholders, and frankly, with all of the policy that we make across the board.
How do you see DFS's role in keeping New York City at the center of one of the centers of in the middle of the financial universe, so to speak?
Well, I do think it is that rulemaking, that good policy that comes from engagement. I think having those transparent rules, as you know, New York had banking law before there was national banking law in the US. So I always joke, despite what we all learned in the Hamilton musical about why Wall Street is in New York, my personal view is that Wall Street is in New York because that's where the laws were first. That transparency, that predictability was in New York, and it led the industry to be based there. And so I think continuing that tradition of having clear rules of the road, of engaging with industry, is going to help cement New York's place. And doing so in a way, again, based on the philosophy that you can be good for business and good for consumers and good for markets all at the same time. The other thing I think is something you mentioned as well, which is because we're not part of the DC alphabet soup, because we can be a little bit more nimble, and that allows us to be at the cutting edge, right? To be issuing stablecoin guidance, to be thinking about liquidation authority in the space, while in DC, people are still trying to figure out what the legislation looks like, who's the proper regulator for the space, so we can move much, much more quickly. And because it's New York, really set a standard, not just for other state regulators or for federal regulators, but around the world. I think one of the things that's been really gratifying for me in coming into this role is when I travel or when folks are in New York, they say, especially in the crypto space, we know if a company has passed DFS's test, it's good to pass our test as well. It really has become, I think, the good housekeeping seal of approval for regulators around the world, and that helps cement New York's place as a financial leader.
How do you create regulation that's well suited for the different way of doing business in the fintech space? You know, if you just apply the old regulations, you're probably going to strangle the industry, and innovation is going to be hard to come by.
Yeah.
So how do you adjust what you're doing to sort of support the industry as opposed to stifle it?
Well, I think one of the things we've worked very hard to do, to your point, is not just to take old frameworks and try to shoehorn new products, new instruments, new business models into the old regulatory frameworks. There are certainly things to be learned from existing regulatory frameworks, right? Our cybersecurity regs apply across the board to all of our regulated entities. The same is true of our BSA, AML regulations. But when you look at fintech, there are different models, there are different risks. So how can you then tailor what's in the reg? And we usually look at the regulation as a baseline and then say, okay, how do we take from this and tailor to the unique risks presented or opportunities presented by new ways of doing business? In the crypto space, we do that via individual supervisory agreements for each company. We also have prior approval on any new or any material change in business, new coins, new products. So we can say, look, if you're moving from an established chain to a newer chain that maybe is a little bit riskier, maybe breaks more often, your cybersecurity policy, your BSA policy, your consumer disclosures need to reflect the risk in this new product. Similar when we look at other parts of fintech, earned wage access, buy now, pay later are hot on everybody's minds, certainly in the US. With the earned wage access, I think a lot of regulators were quick to say, well, these are loans. And so let's put it into a lending framework. But if you really do a good taxonomy of the space and step back, it becomes clear pretty quickly that some of them are loans, but not all of them are loans. And so they don't actually fit into that regulatory framework, and they need something new. Maybe that borrows from a lending framework, but that is going to be different because the business model is different. But it does just require that data-oriented, data-driven, non-ideological approach to regulation.
Yeah, presumably you care about the outcomes,
Yes.
but not how you actually got to the outcomes.
Yeah.
What sort of dialogue occurs between you and the fintech companies in terms of, you know, this is what would work for us, no, but this is what we need to accomplish? No, there must be some back and forth.
There's a ton of back and forth, sometimes to the great frustration of all parties when we're doing that back and forth. But for me, I go back to my time as a fintech entrepreneur when I was starting this AI-based insurance company. And my mode of operating was, before I ever filed a single piece of paper with the regulator, I would go and meet with them. And I'd say, here's what I'm trying to do, and here's why. Here's what I think might be some of your concerns, and here's how I propose to address them. Have I missed anything, right? And to really start the dialogue. I think that's unusual for companies, both incumbent and sort of new actors. For incumbent companies, because they have a little bit of muscle memory about being adversarial with regulators. For new companies, just because they don't know what it's like to be regulated. And so for us, it really is about a culture change in making sure that people see us as a collaborator and that we do share objectives. But it's a challenge, and it's a work in progress for sure.
I mean, presumably sometimes they're probably scared to ask you because if they ask you, you'll say no.
Yeah, and I think, you know, again, going back to my time as an entrepreneur, when we were standing up this insurance company using AI, I knew the regulators were going to say, well, how do you guard against bias? And the way we guarded against bias was we didn't use any personal data at all. And we took out a lot of the data that could be used as a proxy for protected class or other things. Now, the data scientists in my company would say, well, but if you add this, it makes the algorithm, 20% more predictive. And I would say, right, but that predictive ability is going to do you no good if you can't operate in any state in the country, right? It's just a trade-off. And And so we would anticipate those kinds of questions. And I think I'm optimistic that we can really make this culture change so that more and more companies feel comfortable coming in and having a dialogue with us. And I think it's been true in my time at DFS that we've been able to encourage people to do that.
I mean, I personally think if companies are regulated well, that actually builds trust in the industry, and it's in the interest of the industry to have trust. So It seems to me like there are actually some things where what they want and what you want are very compatible.
Yeah, I think that's right. I mean, we're here to make sure that legal activity happens safely, right? It's not a regulator's job to stand in the way of legal activity. It's our job to make sure it develops and grows safely. And to do that, you have to have that partnership. You have to have that dialogue.
So DFS, you're doing your thing. The regulators in Washington are doing their thing.
Yeah.
There's activity going on in the BIS and the Financial Stability Board in Basel. How do you coordinate? How do you have dialogue? How do you intersect with all these other things? Because you have to anticipate all these other developments.
Yeah, absolutely. It is complicated. There's a lot of actors in the space, but I think that's a good thing. I think it allows us to really throw around ideas and to kick tires when folks are proposing something. When there's legislation on the Hill, there's been a lot of legislation on the Hill this year around cryptocurrency and digital assets, and they come to us and we offer technical assistance and we say, here's what this is missing, or here's something that could be tweaked. And similarly, people come to us all the time and say, have you thought about this? Have you thought about that? It requires, again, that trust and that partnership. It requires having the right talent to understand and anticipate and engage with a variety of stakeholders. But sometimes that's not always possible. I think certainly in DC there's been a lot of energy and attention around which regulator is going to have ownership of the space. There's some turf battles. And as we're providing technical assistance on some of the legislation, we're not invested in the turf battle. I don't care which regulator in DC gets to regulate the space. I want the regulation to be the best possible regulation there is. Again, it's one advantage we have of having explicit authority over digital assets. We're not worried about which box does it fit in because we realize it's a new box. But it does take a lot of work, a lot of energy, a lot of time to stay abreast of developments and conversations and to stay engaged with other parties in the space.
It seems the national regulators are pretty far behind where you are. From your perspective, selfishly, as the head of DFS, do you want them to catch up?
I absolutely do. I absolutely do. I mean, I think New York will always be a leader just because we are more nimble, because we've been able to amass this expertise over time, and we'll always sort of have that lead. But the more regulators in this space, the better. So I look forward to the day when there are more regulators of the space in DC, that there is legislation that gets completed, and we have even stronger partners there.
So I'm going to switch gears here. So we've had very rapid technological progress. So some people would say it's not progress in financial services, and lots of the number of distribution means have proliferated dramatically. How do you feel about that from a perspective of financial inclusion? How do you worry about people who don't have access to these new technologies, can't participate in these innovations? And what do we do about that?
Yeah, it's a real challenge, and something I've spent a lot of my career thinking about. On the one hand, as a regulator, you have to put these safeguards in place. We've talked a little about consumer protection already. On the other hand, what you don't want to happen is that the early adopters reap gains from technological advances, and then the regulators come in and they bring the gates down and they automatically cut out other folks from gaining from advances in technology. But as you know, often in government, you're looking for the least bad answer, because there's never a perfect answer. There's rarely a really good answer. It's often just the least bad answer. For me, I'm the first person of color in my seat, and so I think a lot about how do people experience the financial services they're using, whether it's an incumbent institution or a new institution. One of the things we've done at DFS, for example, not to go back to the crypto space because the fintech space is much broader than that, but I allow my staff to invest in crypto. And I think almost every other regulator has done the exact opposite. For me, it was about allowing the regulators, the supervisors, to have that customer experience, to know what it's like to be on board. Now we have lots of ethical guidelines. You have to get approval from the general counsel's office. It has to be issued by a regulated entity, so there are lots of hoops to jump through. But it felt important that we at DFS can have that consumer experience. I think in general, fintech has been more talk than action around financial inclusion. It still really is aimed at early adopters, at people who already have banks and have credit, right? So they haven't done that much to really make a dent in financial inclusion. And that's disappointing to me because I think there's a ton of potential there to really make inroads in not just including people that have been excluded, but really making a big dent in their financial health and their financial wherewithal. Because we know when people are financially healthy, when they have savings and insurance and wealth, what that means for their careers, for their children, just for their state of mind and their mental health and emotional health and physical health. So for me, having that economic security is incredibly important, and making sure that we at DFS are putting ourselves in the shoes of the user and thinking about regulation from that perspective, hopefully will help the space advance to a place where they're thinking more about the underprivileged, the excluded, and other marginalized groups.
So where do you think we're going to be 5 to 10 years from now? I mean, there's a lot of hype, and
It's a lot of hype.
but there's also some real promise. I mean, I think our view at Bretton Woods Committee is that, we think the technology is really interesting, and we think there's actually a lot of possibilities for very positive use cases. How do you see it going in the next 5, 10 years?
Yeah, I agree with you. I mean, I've always been very bullish on fintech. It was part of the reason when I left the White House and I'd been doing all this fintech work after the financial crisis. We were working hard to implement Dodd-Frank, as you know, but I kept thinking to myself, there's certainly things we have to fix that were gaps in the system, but let's look forward. What are the opportunities? How do you regulate financial services, to your point, toward a set of outcomes? What do we want financial services to do, not just what don't we want it to do? That's obviously much harder. My hope is that in the next 5 to 10 years, we will see real progress on inclusion. It won't just be innovation for innovation's sake. It won't just be innovation for speculation, but that investors and entrepreneurs alike really will spend more time thinking about how to make things better, how to make financial outcomes better for consumers and for markets, and that there'll be more investment, more energy put toward those objectives rather than some of the things we see now.
You had to bet. Will you think this is mostly going to be disruptors really upending the existing financial industry, or financial industry taking on the innovations and sort of incorporating in their own ecosystem?
I think it'll be a little bit of both. When fintech first came around, I was in the White House and people would come in and they'd say, oh, in 10 years, Citibank isn't going to exist, Bank of America isn't going to exist, we're going to disrupt the whole thing. And you hear that a little bit now from the crypto crowd too. But then, just a little bit. But then they realize that customer acquisition is really hard and expensive, and compliance is really hard and expensive. And there's something to be said for what the incumbents have done and built. So I think we'll continue to see more partnership. You'll see more incumbents improving their technology. You'll see, I think, less sort of cowboy attitude. Maybe I'm projecting my own desires here on the space, but a little bit more focus on the usefulness of the innovation.
It'd be good, a little bit more overperform rather than under-promise, overperform.
Yeah, under-promise, overperform, absolutely.
Rather than the reverse.
Absolutely.
So I'm going to see if we have some questions from the audience. I have a little laptop here to help me. So it's an interesting question. We on the other side of the planet still have to try to make sense of the U.S. Securities Exchange Commission doctrine. Like, what are they for in terms of crypto as a security and all that other stuff? Can the DFS help provide clarity in the securities space? It's not really your regime, is it?
Yes, no, it is not, and it's. But I do think, look, we spend a lot of time with our regulated entities and folks who want to be regulated by DFS, talking with them about what's happening on the federal level, including coming out of the SEC. And certainly where there's overlap, right, where the SEC is doing work, and I think a lot of their work has been through enforcement in the space, right, really trying to work with our companies so that they're not running afoul of those laws and our laws. So where there's overlap, I think we do a lot of work with the SEC, but as you said, it's thankfully not my purview to decode their trajectory.
So let's talk about stablecoins. We have another question from the audience about stablecoins. So where do you think we stand? I mean, we just had a huge disaster a few months ago with Terra and Luna blowing up algorithmic stablecoins. Where do you think we are? Do you think what you have is a good mousetrap? 100% reserves backing stablecoins. I mean, my own personal view is that this is more of a sustainable regime now, where interest rates are not at zero. So you can actually take your reserves and you can invest it and earn a return. So the business model has I think, improved pretty dramatically.
Yeah, absolutely.
So where do you think stablecoins are going?
Yeah, I think we're going to see a lot more development in the stable coin space, and in the truly stable coin space is my hope. As I said, we didn't approve any algorithmically backed stablecoins.
And I'm pure glad you did.
Yes, it proved to be very smart decision making by the team. I think we're going to continue to see development, I think especially as we await real-time payments from the Fed. I think the real question will be what will happen to stablecoins if and when there's a U.S. central bank digital currency, and whether there's still the need for both the private and public currency. There's a lot of discussion about that at the festival this week, and a lot of differing opinions. I think that's really going to be the most interesting inflection point for the space, is if we see utility, and if the private sector can provide utility for private stablecoins as CBDCs become more ubiquitous.
Yeah, it'll depend, I think, in part on whether central bank digital currencies can have interoperability with the digital world, the crypto world, because that's right now stablecoins are just really the linkage between the two ecosystems, and so the question is, if you invented a central bank digital currency, can that perform that linkage? Well, it sort of depends on how that digital bank currency is actually created.
Yeah, absolutely.
What do you think about tokens? So tokenization can be used for a whole bunch of things. It can be used for, I have a token that proves that I own my house. All of a sudden, we don't need title insurance in the United States. Anybody who's bought a home in the United States, it's just amazing all the hoops you have to go through to just prove that the home you bought is your home. So you can imagine, a token could be pretty valuable in that sense. What do you think the future of tokens is, and how does DFS think about tokens?
Yeah, I actually think we're going to see much, much more tokenization of assets. And for us, that means, I mentioned at the top, we've got these two licensing regimes, the BIT license and the limited purpose trust charter. And I think as we see more and more virtual assets shift away from cryptocurrency toward the tokenization of assets, that limited purpose trust charter is going to prove to be prophetic in a way, because I think that license is going to become much more attractive than the BIT license. Right now, of our licensees, most of them are BIT licensees, not trust charter holders, and I think that's going to flip over time. So as a regulator, I think we're well prepared for that shift in the space, but I think it's going to make a lot of things more efficient. I mean, title insurance, I think, is a fantastic example. I think as we think about all kinds of assets and ownership, and we think about inclusion, my hope is that digitization of assets really opens the space for those who have been excluded and marginalized as well.
Yeah, I mean, I think with tokens, you could probably have much faster settlement. For example, in the United States, we still have stocks trade on a T+2 basis, which is just remarkable when you think about it. We haven't been able to progress farther than that.
Yep.
Any final thoughts, messages you'd like to leave us with?
Yeah, well, those who've heard me speak before have heard me say one of my main messages to industry folks is always never surprise your regulator. That's rule number one. If I have to read about it in the press before you've come and told us about it, we've already started off in a bad place. So please don't do that.
Ask permission as opposed to
forgiveness. Exactly. Ask permission, not forgiveness. But it really does set the relationship up in a much different way. And again, it really is my hope that as a financial regulator and as the financial regulator of New York, that we're charting a course that others will follow, around an engaged, modern, data-driven, non-ideological regulator that can be nimble, stay abreast of developments in the space, and as I said at the top, be good for consumers and be good for business at the same time. So that's really my aim.
So this is the first time that we've met each other. I'm very impressed, and I'm really glad that she's in that seat. Thank you.
Thank you.